and backing out whatever we had in the beginning of the year, if anything. Perfect. Okay, what do I wait for that? 5 points? Okay. I guess I had 2 dead batteries. Okay, so what we've been doing at the end of the period, like in this situation here, the company has 2 investments, both of them with unrealized appreciation of $40,000. At the beginning of the year, the balance was 0, and so that's our adjustment for the year. So no problem if we haven't sold anything. Okay, if we didn't have a bid balance to start with. Okay, so let's look at this. Illustrate it. So I had Lehman, and I have this other guy, Woods. Okay. And so the costs, or how much? 120. And 120. And fair value, 105 and 135. Okay, and so the unrealized amount is 25 and 15. Okay, so 40,000. There was nothing at the beginning of the year, so the adjustment for the year is 40,000. Very simple. Okay, so move ahead here. And that's what the comprehensive income statement looks like. 350 realized net income plus this 40 for the year. So comprehensive income was 390. Okay. Now, during the year, they sold the Lehman investment. Okay, sold Lehman for 105 and realized a gain of 25. At the end of 2012, fair value of Woods increased an additional $20,000 to 155. So at the end of the year, we have this situation. Should be 35, was 40 from the beginning of the year. Okay, so we have to decrease our fair value account by $5,000. Okay, so what really happened here? Okay, this investment went up to 155, it increased to 35,000. So what it really did was to go up by 20,000. Okay, so what we really had for 2013, we really had $20,000 increase here. And this one went away. So that's gone. 25,000. Okay. So what we really have, to make up that 5,000, we have 2 pieces. We have a gain, additional gain in the Woods investment of 20, and we've reclassed out 25 because that all got realized. What I wish they didn't do in this example was have the sale at the same amount that it was the fair value at the beginning of the year. That sale could have been something other than 105. The point is that we're reclassifying this. When we do a net calculation, we really have 2 pieces. We have the removal of the amount that was there for Lehman, the 25, and we have additional 20 getting this from 135 to 155. So the 5,000 is really 2 pieces. And the way it would appear on financial statements would be, it's really 2 pieces, okay? It's the unrealized, this is the net. 5,000, comprised of a realized holding gain of 25 for the one that was sold, and additional unrecognized amount of 20. So on the income statement, that's the way it appears. You don't just show the net of 5, you gross it up and show its two pieces. So at the end of the year, they had, I guess I said 13, it was 11 and 12, not 12 and 13. So they had 720 in realized net income that year. And that includes the 25,000 from the sale. That's included in net income. Okay? And then down here, what we would do is to show the 5 in 2 pieces. It's still 5,000 using the plug method. What it was, what it is, what it should be, what it was, what it is, and what we need to adjust to get there. Okay, so the way it would appear on an income statement is that the 25 is being reclassed out because that was sold. And the 20 is the additional fair value increase for the one we still have. And that's what all was told. Okay, so basically, when you sell, any amounts that have been included in other comprehensive income relative to the items that are sold, okay, they're reclassified out and we gross up the income statement. Very simple situation here, we only have 2 investments. It gets a lot more complicated when you have like 20, 30, 40, some being sold, some not being sold. It could get very confusing. So I just want to illustrate that that's what goes in. What? Simple. Simple questions. We won't be blindsided by this situation. I'll show you that.
Whenever we're looking at it, or if we're looking at a problem and it just says net income, but it was like in the problem how technically they sold something, should we assume that it includes the gain?
Whoops. I got this new sensitive battery. Let's see, my red dot's working too. Like here?
Yeah.
Yeah.
So, but if it just says net income, but it doesn't say anything about including it, should we just?
No, but that's all part of it. Once you sell it, that's part of that income. Donna, do you have a question?
Well, it looks like they sold it for the fair value, so they sold
Yeah,
it for.
I wish they didn't do it that
more
way.
than,
I wish
you
they
know,
didn't do it that way.
It's just
I wish
too-
they sold it for more or less than that, just
Too simple.
coincidental, yeah,
I mean,
right.
yeah,
It would still be a reclassification of the 20 that was there. They could have sold it at a gain of 50,
okay.
and the realized gain was 50, but the realized gain includes, we're still taking 25 out, because that's what was there. That would not have changed this,
Oh, it wouldn't have.
no.
Oh, that's what.
Because what's going out of here is the 25 that was there. So unless you have further increases in the fair value, that has no effect on this.
Okay.
That would have been additional appreciation and investment in the year they made the sale.
So would it be in net income or would it just?
Yes, yeah, unless you adjusted this account first, which is doubtful. This is like a year-end adjustment.
So you're the net income.
So if you sold it at a $50,000 gain, it would be including the 25 that had appreciated at this point and another 25.
But then underneath it, it was.
Right. Because all we're doing here is taking out the piece that was in here.
Okay.
Okay, that's real reclassification. This table and this table, in a nutshell. Okay, these are not all that important. You have enough before starting to. When you transfer an investment from one one category to another, if you so happen to do that. It's rare. You transfer it at fair value. That's all you do. And you should not see transfers from held to maturity to AFS or something like that. Okay, because once you make that determination in the beginning that it's a held to maturity, that means you've said that future gain, unrealized gains and losses will not be recognized because I'm holding it until it matures. If companies do that prematurely, they do it prematurely, that's considered tainting the portfolio. So regulators would make you put the entire portfolio in AFS or trading. Okay? All right. A couple of controversial things about fair value. Okay, so, like I just told you, with held to maturity, it's very subjective, based on intent. And so, if you're gonna use fair value accounting, even for your held to maturities, there's a lot of subjectivity, and some people don't like that. The other thing is, by using fair value accounting, you can do what's called cherry picking. Okay, so a company, if they want to improve their results, they could sell all the winners, keep all the losers. So all the winners get sold, all the good investments, those that are appreciated, and you know that you recognize the gains in income, so the income statement reflects all these gains. Meanwhile, all the securities that you have that are underwater, they're sitting on the balance sheet, and their unrealized loss is part of equity, not part of income. So that's something else controversial about fair value accounting.